We have Tarun Birani, who's the founder and CEO of TBNG Capital Advisors, and Shweta Rajani, Senior Vice President and Head of Mutual Funds at Anand Rathi Wealth. And we will be answering all the queries which have been sent in by our viewers. I realize that for a long time we have not done that. So today we hope to take up some queries, and of course in the coming weeks there will be more queries answered. So do keep writing into us. The first question that we have comes in from Mumbai. So Matthews KP has written in. He says that he has an ongoing SIP in PGIM India Global Equity Opportunity Fund for the last 2 years, and currently it's making him losses. So he wants to know whether to continue the SIP or to switch to some other fund right now. Shweta, I know 2 years is too short a time ordinarily to judge the performance, but a lot of funds have done well. And is this the reason that sometimes investor returns lag fund returns? What should he do?
Sure. Thanks, Mera. Hi, Matthew. So, PGIM Global Opportunities Fund basically is investing almost 50% of its money in US markets, and there's another 40% or that goes into European markets. The last few years, I would say, the recent months have been impacted because of the global uncertainty, and these countries are facing economic challenges, a high interest rate, inflationary environment. But when you compare Indian equities to these markets on fundamental factors like, what is the expectation of corporate profitability, relative valuation, how is India's economic growth going compared to others, India seems to be better placed than these two economies. Like, I'll give you an example. A valuation measure is market cap to GDP. For US, it's at 170%, and compared to their own average of 140%, they're on the higher side. India is at 105 today, which is still closer to their long-term average of 90. So India is relatively better valued. You have US and Europe, which are going through a degrowth in their economy, whereas India at 7% or GDP growth expectation would be among the fastest growing. So, not just how the performance has been recently, but going forward also, we think that Indian equities will perform better than these markets. So my recommendation to you would be that stop your SIP. Even if it is at a loss, book your losses, move out and invest into Indian domestic funds.
Okay. So Matthew, I hope you were listening in. The next query comes to us from Balkrishna Rao Kadiri, who has written in from Vishakhapatnam. Now he says that he has been topping up his SIPs from time to time for over 5 years now. He says his Aditya Birla Sun Life MNC fund does not look as impressive when he's compared it to the benchmark returns. He also wants to know whether he can switch to some other fund, and if switching will impact his compounding, the compounding in his fund right now. So, Tarun, what would you advise Balkrishna to do?
Yes. Hi, Sumera. So, first of all, I want to take this question in a slightly different way. I see 95% or most majority of the investor ask this question: how can I increase my returns? But frankly, if you look at the world is very, very different, right? The actual world is very different. What I am saying today, after 1 year, it is going to happen like that. Trust me, there is a lot of uncertainty around it. So focus need to be, how can I increase my return, to how can I achieve my life important financial goals with a lot of certainty. That should be the focus area. I can see Mr. Bala has asked very specific question: how can I better compound my money? Should I change my SIPs and all that? But after you are focused more towards achieving your life goals, then you start coming up that what am I investing for? Is this investment more for my short-term goals or long-term goals? I can clearly see this money is for his long-term goals. One problem what I observe in his portfolio is the number of funds are too many, and I can see these 8 to 9 funds in the portfolio is not a good thing to have in the portfolio. Each category, one fund need to be there, and there is no need to have too many funds in the same category. Like I can see there are 2 flexi cap funds in the portfolio. There is no need to have two flexi cap funds. There is a need to have index fund in a large cap category, because I don't see large cap funds outperforming the benchmark meaningfully. So no need to pay that extra expense ratio. Apart from that, his specific concern on this thematic fund called MNC fund, ABSL MNC fund, yes, it is underperforming, but one should question why this MNC fund or a thematic fund was taken at the first place. I feel if your objective is long-term compounding your money, a good diversified fund can take care of it. No need to go outside the diversified category and stay focused more in the same, rather than going into a thematic fund like a MNC and all these kind of category. So I am a big believer of reducing and play it under your circle of competency, not to try do 8-10 funds in the portfolio, because it kills the return. And to his specific question, if he switches this fund to another fund, trust me, if he's putting it in another equity fund, his compounding cycle will continue, so he don't need to worry about that.
And also the Birla MNC fund has had a change in fund manager, so maybe in any case he should have reviewed his investment. Okay, next question comes from M. Dabat. Shailesh Singh has written in. He says he's 52 years old. He's a salaried professional. He's been investing in a variety of funds for now the last 6 years. He wants to know whether it's advisable to have more than 25% corpus, a quarter of his portfolio, in a single AMC, as he has already exceeded the cap for Axis, Mirae, and soon he expects that he will exceed it for Parag Parikh Mutual Fund as well. His primary aim is to create wealth by the time that he is going to retire. So too many eggs in one basket, perhaps, Shweta?
Sure, madam. Sally, so one thing, you would also share your investment details. So one point there is, today you said you've accumulated around 20 lakhs, and with the way you're going of your monthly SIPs, you will end up with 1 crore. My first suggestion to you is, as you go towards retirement, just relook at your asset allocation. If you're equity heavy today, maybe as you get closer to your retirement, you may want to have a little more debt. Coming to your specific question on your mutual funds, yes, I would ideally say that 20 to 25% exposure to a single AMC is the limit that you should have. If you exceed 25, that's your upper limit. You should diversify. Yes. I'll just take an example like Axis today is going through a series of audits which would impact its flows and therefore the fund performances. So that's the AMC risk I'm referring to. Third, in your portfolio, it's not just the AMC risk, but I also see a fund manager risk, because you have Axis Midcap, Axis Focus, Axis Blue Chip. So two of these funds, Midcap and Blue Chip, are managed by the same fund manager, Shreyas Devalkar. So you also have a fund manager risk, every fund manager has its own style, and that goes through a cyclicality. So, therefore you need to bring that down also in your portfolio. Coming to your specific schemes, I would say with the 3 Axis funds, you can continue to retain an Axis Midcap, Focus Equity, and Blue Chip. I would suggest you redeem in your portfolio. Alternatives to this would be you can take an ICICI True Focus, or you can take a Franklin Blue Chip instead of Axis. You have a Kotak Emerging in your portfolio. That's amongst the top quartile funds, so continue retaining that. Mirae, again, you have 2 funds, Mirae Emerging and Mirae Large Cap. Mirae Emerging is a good fund. You can continue. You need to bring down your exposure to Mirae. So reduce exposure from large cap. You can retain Emerging in the portfolio. The other fund you have is a Parag Parikh Flexi Cap. This fund used to have 25% exposure to international equities, which did well for him, but today that is hampering the portfolio return. I would say better funds available in that category. I would suggest exit that and switch to an HDFC Flexi Cap in the portfolio. That's some suggestions. I hope I have covered all your schemes that you had mentioned.
Yeah, that's it, Shweta. Thanks for that. Another question is coming in from New Delhi. Satya Srinivas says that his daughter has recently got a job, so he wants her to start investing for the long term. So now he wants some suggestions of mutual funds with good return. So Satya, congratulations. It's a great thing for you to be teaching your daughter. But first up, let me tell you that this concept of good returns, selecting a fund on the basis of good returns is itself a myth. Because if anybody is guaranteeing you a good return, or if somebody has performed well, it doesn't mean that it will be repeated. But anyway, Tarun, you're the expert. Go ahead.
No, I think you have made my job easy. I think the word return need to be seen because I think if you look at, this is called the recency bias, right? When you look at last 1 year return, 2 year return to select what is going to happen in future, I think you'll end up making a lot of accidents and mistakes by that. So I'm a very big believer of suitability of the investor based on the risk appetite. One should approach the investment. As Mr. Satya has clearly mentioned, it's for her daughter's future as well as it's for long term. She's just starting off the investment. So my suggestion would be she should look at starting with high allocation towards large cap oriented index fund. That would be a great start according to me, followed by some allocation to large and mid cap category. Again, to add alpha to the portfolio, we should look at some allocation to long-term allocation to some flexi cap and mid cap funds. But after some year of experience, I want 1 or 2 years, let us start something, see and reflect back her experience investing, and if she gets more comfortable with investing, I think she need to get into bit of small cap allocation because she has a long term horizon. But I would not like to give very high risk small cap at this point of time because she is a first time investor. Let her experience for next 1 or 2 years be good in the market, she understand risk well, then we can add up more risk. Again, my current suggestion would be start with 2 to 3 good top quartile fund from both qualitative and quantitative metrics as well as good parentage fund house, and that will be a great start for her to have a great experience.
And just to add my 2 bits to it, if you follow all the steps of the process of asset allocation, you will anyways land up with funds that will be most meaningful to your portfolio. You don't have to just select ones on the basis of returns. A quick break. We have more queries which we'll answer, but all of that is on the other side. Stay tuned. Hi, welcome back. You're watching MF Corner. We have our 2 experts, Tarun Birani of TBNG Capital Advisors and Shweta Rajani of Anand Rathi Wealth, answering queries which have been sent in by our viewers. The next question that we have, it's actually 2 questions coming in on similar lines. So we have Aya Vishwanathan and Arvind Kulkarni who have written in to us, and this is regarding the MF nomination rules which have been revised by SEBI. So Aya says that all his investments have been included in his Demat account with Integrated Enterprises India. He wants to know whether it will now be necessary for him to register individually for all his investments. Arvind says that he wants to nominate friends, charitable institutions, religious places other than his family members. So he wants to know whether it will now be possible under the new norms. Tarun?
Right. So I will take Arvind's question quickly. So a nominee is only a custodian and not the owner of the mutual fund holdings, and legal proceeds will only go to the legal heirs. Okay. So this is not a new MF nomination norm, right? So this is a SEBI regulation made in 1996. So new nomination rule speaks about compulsory nomination or provide a signed declaration if you are opting out of nomination. Nevertheless, in case of demise, if you want the proceed to go to a respective friend, charitable trust, as well as religious places, then it is necessary to add the same in the will document. Though nomination are being done with self-consent, legal heir is entitled to succeed to the property as per the succession laws. So to sum it up, on demise of a mutual fund holder, the proceeds are given to the nominee, who in turn must distribute to legal heirs or to the person entities mentioned in the will document. So I hope this answer is very clear to Mr. Arvind. Now coming to the second question, if your nomination is updated in your Demat, do you need to still update it in the mutual fund separately? I don't think that is required. If in your Demat the nomination things are updated, then no need to update it separately. But if you have not updated the same, then you have to get this updated in the system. Thank you.
Okay, Tarun, thanks very much for clarifying all those aspects. We have a query from Pune. Deepak Mirchandani says that he has an ongoing SIP in the iPru Tech Fund where he has chosen the growth option. He has been making SIPs every month since September of last year. He says that he has not received units against his SIP and wants to know what should be the future course of action here. Shweta?
Yes, madam. Sadeep, in July, what had also happened was there was a regulatory change which disallowed using of pool accounts for purchasing mutual funds if you were doing it through a broker or through an MF platform like BSE. So specifically, if you were buying mutual funds in the demat from any of these routes. So in your case, if you're buying it through BSE, then your money got debited from your account, but BSE could not allocate it to the AMC on time, and therefore the money is with BSE. It's not got mapped into the current account, and therefore you've not got your units in your demat. This was a generic problem which came up because of the regulatory change. It's not specific to you. In fact, what we've understood from BSE is there's a huge backlog and a lot of cases for which they still have to make refunds back to the investors, and that's taking some time. What I would suggest is that your AMC is not at fault. It's not that the money is being received by the AMC and they've not allocated units to you. This is an issue with the broker or BSE. I would suggest to stay in touch with your broker. The money should come back to you in some time. And your next few SIPs should be triggered, on timely basis with units being allotted.
Okay, next up, Prakash Sinha from Pune writes in. He says he has been investing about 10,000 rupees a month. He's a long-term investor and would like to have his portfolio reviewed. So as of now, he has about roughly between 1,500 to 2,500 rupees SIP ongoing in the Mire Emerging Blue Chip, Canada Robeco Flexi Cap, PGIM Mid Cap Opportunities, Kotak Small Cap, and the SBI Contra funds. Tarun, what changes would you recommend?
So I would like to first congratulate Prakash for making such a lean portfolio with one fund in each category, and it looks very well structured with very high quality funds in the which demonstrated good performance and have a very good risk reward basis in the past, right? So while number of funds in the portfolio look adequate, but one suggestion I could make out is maybe a large cap or index fund is missing in the portfolio. So maybe in his future portfolio new investment or anything, he may like to consider a index fund, large cap index fund, keeping in mind the large cap index fund will not deliver returns like a mid cap or a small cap, but it will help in bringing more durability in the portfolio. Apart from that, my quick suggestion to Prakash would be to avoid any kind of FOMO kind or the fads or the NFOs kind of thing in the portfolio. Stay focused with these funds which has a 10-year plus track record and which has been performing well consistently, and avoid doing these mistakes in the future.
Okay. Next up, Komal Khurana has written in. She says that at a time when the West is staring at a possible recession, would it be a better idea to diversify funds in different segments within Indian equity than to go international? I don't think right now it's possible to incrementally go more international because we have already exceeded the cap. But Shweta, what would you advise?
Yes. So Komal, I agree with you that the Indian equity markets is far better placed than international markets, and there are various factors for that. One is if you see the way the macroeconomic situation of India is, it's far better than the global markets. In fact, just a few days back, I was reading that India, in terms of GDP, we've exceeded, we've crossed UK to become the fifth largest. So the way we are progressing, by 2027, IMF forecasts say that we'll be the fourth largest economy. and by 2029, India would be the third largest economy. So clearly, the progress in India is far better than others. Even if you look at other factors, corporate profitability, the first quarter results that came in and the projections for this year is saying that Indian large cap companies could grow at around 15%. So could be the larger mid cap companies growing. Valuation is pretty much fair for India. India over the last 8 months, if you see, has been performing far better than a lot of the global peers. Look at trends like FII flows, we've seen a change of behavior. So, these are various factors that we track very closely, and it gives us also the confidence that staying invested in Indian equities would be far better than being in global markets for the next few years. So I agree that, you're better off in having a portfolio which is spread across maybe a 50% large, 30%, 30 to 35 mid, and balance in small through actively managed funds.
All right, Shweta, Tarun, thank you very much to both of you for joining in to advise our viewers. With that, we'll wind up for today. But do keep sending us all your questions and queries. We'll take them up with our experts. For now, do stay tuned in. Closing bell will take you through the last hour of trade.